Right now, a silent war is being fought inside your checking account. On one side is a multi-billion-dollar banking system engineered to keep you stretched. On the other side is you. But there's a secret weapon they hope you never find. A single, ordinary number that completely breaks their profit model. It's not $1 million. It's not even 100,000. It is exactly $20,000. Have you ever wondered why banks get nervous when you finally start building real cash? Let's talk about what happens when you build your own bridge and why the toll road operators are terrified of what you'll do next. Imagine your bank as an old wooden bridge built in the 1800s. It's the only way to cross a dangerous river. The bridge belongs to a private company, and they can charge whatever toll they want because your only other option is to swim. Now, the bridge owner doesn't want you to drown, but they don't want you to buy a boat either. They want you right in the middle, productive enough to keep working, but dependent enough to keep needing their bridge. Month after month, you pay the toll. But $20,000 is the exact moment you begin building your own bridge. Suddenly, you have an option. And once you have an option, the toll road operator loses their pricing power over you, permanently. According to a Federal Reserve working paper, households are classified along a spectrum from financially fragile to financially resilient. And the line the economists draw? It's not $50,000. It's not $100,000. It is exactly $20,000 in liquid savings. Under that line, banks have a special corporate name for you. They call you a high-engagement account. Translated from boardrooms to real life, it means the people we charge the most. Let's look at the 5 invisible extraction layers they use to drain your account, and exactly how 20 grand tears those layers to shreds. In a single year, U.S. banks pulled in an incredible $7.7 billion in overdraft and non-sufficient funds fees. But here is the kicker. Just 9% of account holders paid 79% of all overdraft fees. This isn't a wide net. It's surgical targeting of the most vulnerable. And how do they optimize it? Through transaction reordering algorithms. If you have multiple transactions hit your account on the same day, some banks process the largest payment first. Why? Because it drains your account instantly, causing every single smaller purchase after it to trigger a separate $35 fee. Wells Fargo actually paid a massive $1.4 billion class action settlement for doing exactly this. But when you have $20,000, your account never dips. The algorithm loses its entry point. The toll booth disappears from your route. The average American household pays roughly $1,300 a year in credit card interest, compounding at brutal rates between 22% and 29% APR. Most people think this is caused by reckless shopping sprees. But the reality is simpler. When you don't have savings, your credit card becomes your emergency fund. The car breaks down, you swipe. The dentist bill arrives, you swipe. Because that emergency eats next month's cash, you carry a balance. In the credit card industry, they have names for this. People who carry a balance and pay interest are called revolvers. But do you know what they call people who pay their balance in full every month and generate zero interest? They call them deadbeats. Your ultimate financial goal? Become the bank's biggest deadbeat. Use their points, collect their cash back, and pay them exactly 0 cents in interest. The average checking maintenance fee is $15 a month, or $180 a year. Banks waive this if you keep a minimum balance, usually between $1,500 and $5,000. But when your savings are low, one bad month throws everything off. Your paycheck gets delayed, you dip below the limit, and right when you are at your weakest, the bank hits you with a fee. It's not a penalty for being irresponsible. It's a literal tax on being financially vulnerable. No lender will ever admit this. But researchers found that borrowers under financial pressure pay 1% to 2% higher interest rates than resilient borrowers, even with the exact same credit score. On a basic $30,000 car loan, that desperation premium quietly extracts $1,600 in extra interest. Why? Weak bargaining power. The lender knows you can't afford to walk away. But when you have $20,000 in liquid cash, you aren't captive. You have a second bridge. And the moment they sense you can walk away, the price drops. This is the most expensive layer of all, and it never shows up on a statement. Researchers at Harvard and Princeton tested cognitive performance under financial stress. The results were shocking. Living with constant money anxiety reduces your cognitive capacity by 13 IQ points. For comparison, staying awake for an entire night only drops your cognitive performance by 8 points. Financial stress is literally more damaging to your brain than chronic sleep deprivation. And because your brain is exhausted, you make impulsive, short-term decisions just to get a temporary hit of dopamine. That's why urgency marketing like last day or limited stock works so well on stressed minds. $20,000 doesn't make you a millionaire, but it does something more valuable. It removes the background noise of panic. It gives you back your 13 IQ points, giving you the mental bandwidth to make smart, long-term plays. Most financial advice stops here. They tell you to save an emergency fund, and that's it. But the real story begins with how this number completely rewrites your relationships. Take Claire's story. Claire spent 8 years as a brilliant marketing specialist in Atlanta. But she had a nightmare of a manager, someone who took credit for her work, shot down her ideas, and passed her over for promotions she clearly earned. She went to HR. Nothing changed. So why did she stay? Because she only had $6,000 in savings, a mortgage, and a toddler in daycare. Walking away wasn't a choice. Her manager's real power wasn't his corporate title. It was the fact that he knew Claire had nowhere else to go. But then, Claire's grandmother passed away and left her $18,000. Added to her existing savings, she suddenly had $24,000 in the bank. What happened next was like a movie. Within 90 days, Claire applied to 3 companies, secured 2 competitive offers, and handed in her resignation. Her old company panicked and offered her a 23% raise to stay. She turned it down. Now, ask yourself, did Claire suddenly become more talented? Did she get a new degree in those 90 days? No. The only thing that changed was that she was no longer desperate. And it turns out, not being desperate is worth about 23% of your salary. In economics, this is called outside option value. When you have a real, credible alternative, every negotiation changes. Below $20,000, saying, "I can walk away," is almost always a bluff. Above $20,000, it's a fact. I once spoke with a former bank branch manager in Ohio named Derek. He told me something I will never forget. He said, "We didn't measure customers by how much money they had. We measured them by how much profit they generated. And our most profitable customers were never the wealthy ones. They don't use retail banking. The ideal customer is someone earning $50,000 to $80,000 a year. carrying a credit card balance, occasionally overdrafting, and keeping their savings safely under $20,000. That is the sweet spot. They want you walking on their toll road forever. Let's look at Ryan, a 34-year-old earning $68,000 a year. He brings home $4,400 a month, but after rent, his car loan, utilities, and 8 random streaming services, his monthly expenses are $3,700. He has $700 left in a perfect month, but usually an unexpected expense wipes it out. His savings have been stuck at $4,000 for 2 years. Then Ryan makes one structural change. He opens a high-yield savings account at a completely different bank. On payday, $500 is automatically moved there before he ever sees it. By month 20, Ryan crosses the $20,000 threshold. And look at the chain reaction. Because he has a cash float, he stops relying on credit cards to survive between paychecks. His credit utilization drops from 42% to 9%. In just 60 days, his credit score shoots up by 31 points. He uses that higher score to refinance his car loan, saving $1,240 with a single phone call. Because he has a cash buffer, he switches his auto insurance to a higher deductible, slashing another $732 a year off his premiums. Ryan's income didn't change. His job didn't change. He just changed his financial posture. And his posture changed the price of his entire life. But why does this system persist? Because banks are brilliant at rebranding extraction as protection. Think about overdraft protection. When it was rolled out, it was marketed with friendly slogans like, "Don't be embarrassed at the register." It was sold as a safety net. In reality, if your account doesn't have enough money and you try to buy a coffee, a normal transaction is simply declined, costing you $0. But with protection, the bank lets the transaction clear and charges you $35. They literally turned a zero-revenue event into a highly profitable product and had the audacity to call it protection. In 2010, the Federal Reserve stepped in and forced banks to get explicit opt-in consent for this. The banks fought it with massive lobbying efforts. Then, after 2021, regulators began cracking down hard on predatory overdraft fees. Major banks like Chase, Bank of America, and Capital One voluntarily began cutting these fees because they realized the short-term extraction model wasn't sustainable anymore. Remember Derek, the branch manager? His branch never relied on those short-term fees. His clients were encouraged to build savings. When the industry shifted, other branches collapsed. But Derek's grew because he built long-term relationships with clients who had crossed that $20,000 bridge. If you are ready to build your own bridge and stop paying the toll, here are the 3 specific things you need to do starting this week. Step 1. Calculate your bank extraction rate. Open your statements from the last 12 months. Add up every overdraft fee, every monthly maintenance fee, every dollar of credit card interest, and the higher interest rates you've accepted because your bargaining position was weak. For most people under $20,000, that number is between $1,200 and $3,000 a year. That is the literal price of not having enough money saved. Step 2. Open an account at a different institution. Put your savings in a high-yield savings account at a different bank with a different app and login. When your savings are in the same app as your checking account, spending them takes seconds. A separate bank adds exactly enough friction to stop impulsive withdrawals. Plus, while standard savings accounts pay a pathetic 0.2%. A good HYSA will pay you 4% to 5%. Step 3. Treat your outside option value as a real metric. Ask yourself, if your primary income disappeared tomorrow, how many months could you maintain your life without borrowing a single dollar? If it's less than 3 months, your leverage is a bluff. For most households, $20,000 covers exactly 3 to 4 months of living expenses. That is the point where "I can leave" stops being a bluff and becomes a real hand. The financial industry profits from complexity. They want to sell you complicated products, rebalancing schedules, and high-fee active management. But if someone simply told you, build a $20,000 emergency fund, put everything else in a low-cost index fund, and leave it alone for 30 years, they'd be giving you the absolute best advice possible. Over the last 30 years, the S&P 500 has returned an average of 10% a year. Invest $100,000 at age 35, add nothing else, and by 65, you have $1.75 million. But you can only be patient enough to let that happen when you aren't terrified of the next emergency. The old bridge is still out there. Thousands of people are paying the toll today. Your goal is different. Build your own bridge. Cross it once. And never pay that toll again. Subscribe to Build Your Bridge. Leave your story in the comments below.